taxation is a very important consideration for any investor, but it's particularly important for the property investor. The reason for that is that once you consider taxation, you completely change the perspective of how you're analysing the property. Tax really changes our focus from looking at the property as the property to the property as a tool for an investor to earn a profit. Now, when we're talking about taxation in this context, we're not talking about all of the taxes that are possible, and on property or in a property investment, typically there's quite a number of them. We're specifically looking at income tax. The only wrinkle there is that income tax includes capital gains tax, and so while we're going to include capital gains tax, it's really only a part of income tax. So we're going to be ignoring the other types of rates and taxes, payments to the government, because they're going to be included in our models simply as expenses, because largely that's the way they behave. But income tax is a bit different. It is a function of our profitability, and so it's quite a dynamic part of our modelling. The other tax that we will not be considering is GST, the Goods and Services Tax. We'll be dealing with that in a separate short presentation, but it's not going to be included in our DCF model at this stage. So the tax that we're going to be looking at basically comes down to three different elements of income tax. There's the basic tax, income tax, which is going to be levied against our operations. That's our operating cash flow. The second is the depreciation tax deduction, which is an advantage for us because it's a deduction against our depreciable inclusions. It's not actually a cash flow item directly, but it comes to us as a benefit from the taxation office, so that it is effectively a tax inflow. And the third form of tax or income tax we're going to consider is the capital gains tax on sale. So these are the three places in our model that we're going to have to put a bit more detail, a few more equations. We're going to make some simplifications, and if you want to model with greater precision, then you can note the simplifications here. They really have to do with the some of the details in the current tax law, and for that matter, as time goes on, the tax law may change with respect to property investments, and so the recommendations here will have to be adjusted accordingly. The main one is that there is a provision for purchase costs, or at least some of the purchase costs, not to be dealt with as part of the capital structure, but rather to be treated as an expense which is able to be claimed over the first 5 years of the investment life. Now, this is a particular little detail. It enables you to turn these costs, which are really capital costs, into expenses, a bit like a depreciation expense over the 5 years. And so if you keep your property for a long period of time, this brings your tax deduction forward, which is an advantage in some ways. It also takes it away from contributing to your capital gains tax, and there are reasons why that is also an advantage. The second simplification is we're going to use straight line depreciation here. Now, in practice, probably be diminishing value depreciation that will be used, because it brings the tax deduction forward in most cases, and in many ways it probably better represents the price behaviour, the value behaviour of the depreciable items that are being dealt with. However, here we're going to deal with straight line depreciation. The reason for that is that it keeps our model a little bit simpler. Considering depreciation is a minor part of our cash flow, whatever modelling area you get by using straight line versus diminishing value depreciation is not going to be significant. However, again, if you want absolute precision, then I'd recommend you give some thought to modelling in the other depreciation forms. The third is that we're going to ignore GST. GST is going to be considered to be inclusive for residential properties, and it will be exclusive for cash flows for non-residential properties. Again, this is for simplification in the model that we're building here. If you want to include GST, there are directions on the ATO website as to how GST is dealt with, and you're welcome to add those considerations into your model for your own purposes. It's just that it's a level of complication that I think is a little bit too difficult for an undergraduate subject, or at least the first one. So we'll be making those simplifications. However, even with those simplifications, the modelling is still going to bring us very, very close. What is income tax? Income tax is paid as a percentage of the taxable income. And for most investors, property investment is an extra line of income which is on top of their primary income. Many small residential investors will have a day job, a salary, and so that will be their major income. The investment property they own will be just a little bit of icing on the cake. And the way that the income tax rates work as a function of income, it means that the basic rate of taxation is driven by that primary income. And so we're going to be assuming a simple rate of income, and in practice that would have been adopted from the particular investor. So you have to understand the investor situation. If they're earning $100,000 a year, that'll be one situation. If they're earning 50 or 200, that will give them a slightly different number. And so we don't put in a fixed percentage for our income tax rate. It's taken from that marginal rate. Second point is that we're able to deduct all of our expenses, and those expenses include interest. And you'll be able to see this as we model up our property. The deductions do not include, however, capital expenditure. And so if we replace a kitchen or the carpets or something else which has a fairly long, or at least a medium-term life expectancy, that will be depreciated. It won't be treated as an expense, so you won't be able to claim it as a deduction all in the year of payment. And we'll be dealing with depreciation separately, so don't get too concerned about it at this point. These recommendations, what I'm doing with the modelling, is intended to give you the general rules and also give you some experience in modelling for these general cases. When you apply this to particular investments for your own purposes or as part of your professional practice, make sure that what you do is up to date with the legislation as it exists when you run the model, because the legislation can change, has changed, will change. And also, if you're looking for absolute precision in terms of your model, in other words, including some of these elements that I've suggested we're not going to bother with in this model, definitely look to specialist advice. See a tax accountant to get the exact rules that apply for your particular property situation at the particular time when you're doing it. It's very important to seek specialist advice. If you want to look further into the rules and regulations relating to the income tax on property, go to the Australian Tax Office website and you can explore through that. It tends to change fairly regularly, so putting actual links on is a little bit pointless here, because if you come back to it in 6 months' time, those links will be mostly dead as they keep updating stuff. However, go to the ATO, look for property investment, and you'll find a lot of very useful material, and it's fairly easy to follow, and I'm recommending that you go into that as part of this module. Let's look at now the first element that we're talking about. This is tax on operations. The income tax is payable on the net operating income after interest has been paid. Now, we've already worked out our NOI, we've also worked out interest, and so it's going to be a very easy matter to simply take that taxable cash flow, which is the EBIT less interest, and then multiply it by the tax rate. That's very easy. The income tax on operations is simply, say, the EBIT multiplied, or less interest multiplied by the tax rate. And here is a diagram of how it works in our particular model. and I'm going to give you a demonstration of how to put that into your model as a separate demonstration. And so I don't think we need to really go further with that here. One thing I will recommend to you though, just take note of this, especially if you're a little bit sort of rusty with your mathematics. The sign of the tax on cash flow is simply always the opposite of the sign of the EBIT less interest. Now, we don't have to worry about what happens when it goes negative. Because when it goes negative, we're assuming that you're making a tax loss on your property investment, and that's reducing your salary, your income from your day job, your regular business, your primary form of income. And so if you are earning, let's say, $100,000 a year, and you make a tax loss on your investment property of $5,000 or something for the year, it means that your taxable income has gone from 100 down to 95. And so that means that that deduction then reduces the amount of tax you would have had to pay otherwise, and the fact that you don't have to pay so much is effectively the same as the ATO sending you a cheque in the mail. And a lot of people invest in property specifically to get that tax deduction, that deduction. When it comes to modelling, it means we don't have to do any fancy if statements or blot out equations where the numbers are going the wrong way. You simply use the negative sign, the negative of the EBIT less interest times the tax rate, and that will always give you the right number. So regardless of whether the before tax cash flow was positive or negative, the tax on cash flow is simply the opposite sign. Easy. I'll be demonstrating the use of absolute addressing so that you can fill your equations across, and by now you should have seen those already. And we're not dealing with CGT. I'm also recommending that you check all of the calculations that you do with your financial calculators. Now, I can't stress this enough, because invariably the week before the exam people come along and say, oh, do I need a financial calculator? Where do I get it? How do I use it? Because in the exam you can't take a computer in, and so any financial calculations, like the kind of calculations we're doing here, will have to be done on a financial calculator. It's also a useful skill for you to be able to use a financial calculator to work independently of the Excel spreadsheets or any other spreadsheets you happen to be using. It helps you to understand the way the math's going, rather than simply see it as what button to press in your spreadsheet program. Okay, so definitely get a financial calculator, learn how to use it, and check your computer models using a calculator to give you skill at using the calculator, to give you confidence in understanding the mathematics. Really, really important. Let's move on now to looking at depreciation. This is the second item that needs to be considered as part of our income tax. Now, depreciation is applicable to those parts of the building that have short and recognised economic lives. And so we've been talking about replacing the carpets. That's an easy and obvious one. Carpets don't last forever, especially in investment properties. Also things like bathrooms, kitchens, curtains, hot water systems, quite a number of things. In fact, in the ATO website, you should be able to get an idea or a listing of the typical things which are depreciable within properties. At various times, the entire fabric of the building have been able to be depreciated, and that's kind of useful for property investors as well. And so find out what you can depreciate and also look at what rate. For the modelling purposes here, we're going to assume that the depreciation rate is matched to the life expectancy, the economic life expectancy of the depreciable inclusions. And so if we have to replace the carpets every 10 years, we're going to depreciate it over 10 years. It may be possible in practice, and this is where you need specialist advice, to be able to depreciate these things at a faster rate. So you might have a carpet, if you can depreciate that over 3 or 5 years, even though it's going to be in the building for 10, well, that's quite acceptable. Find out what the rules are, what you're permitted to do, within the framework of the ATO recommendations, regulations and so on, and then sort of model up appropriately. However, for here, we're going to be making that simplification, makes our math simple, conceptually it's a little bit simpler and so on. Now, the unusual thing about the depreciation is that the cash flow is significant only as a tax deduction. And so the mathematics of it is very simple. The cash flow value is the depreciable allowance for that particular year times T, D times T. And you'll find that in many finance books, D times T gives you the depreciation cash flow. Working out the quantity D is simply the initial cost of the item, whatever it is, divided by its economic life, divided by the length of time you're depreciating. Now, in saying that, we're assuming a straight line depreciation. I'm not going to go into other depreciation schedules for this course, and so if you want to use a different depreciation schedule, the mathematics is going to be a little bit more complicated. It has a slight tax and investment advantage, but we're not going to be bothering about it here. So D times T, where D is the initial cost divided by the number of years it's expected to hold together. Depreciation inclusion is included in the model around row 30. Row 31 we've already dealt with in terms of capital expenditure, and these two are really closely related in the model we're building. But row 30 is where you're going to be putting the numbers in, and that's part of a separate video. You may find it useful to use the notes on this page to understand what the demonstration video is showing you. I won't bother about going through it here because it's also covered on the video. We move to capital gains tax. Capital gains tax is calculated in this panel, which we left blank when we built our non-taxed model. Now, the rules for capital gains tax are curious, and they have changed. When capital gains tax was first introduced about, 30 or 40 years ago, back in the 1980s from memory, it was worked out in terms of capital gains, the real capital gains compared to inflation. When inflation slowed down and kind of virtually almost disappeared around 1990, the rules for capital gains tax, or the obligations of the tax, were changed. The idea of real capital gain was taken out, and it was replaced by a tax which ran at half of the apparent accounting capital gain. Why is it a half? Well, if you go back to 1990, that meant that people who were expecting to pay tax on the real capital gain, with inflation taken into account, would be paying more or less a similar amount in the new system as the old system. However, the new system means that even in a low inflation environment, capital gains tax is a very cheap tax. And if you have a choice between paying income tax from, say, operations compared to capital gains tax, definitely try and structure things so that you're paying capital gains tax, because it's basically taxed at half the rate. You need to work within the legislation, because the cheating, what's referred to as tax avoidance, that is, avoiding the tax that you are legally obligated to pay, is a rather nasty criminal activity, and you'll get treated rather harshly for it, which is quite appropriate. Breaking the law, being a criminal, never a good thing. However, tax minimisation, that is working within the law to pay the minimum amount of tax which is necessary within the positive framework of the law, is not only legal but rather desirable from a finance investment point of view. And so be on your, keep your eye out to make sure that you're working within the law carefully, but also benefit as far as the provisions allow for. Again, I'll be covering this in a demonstration of how to practically do it on our model. You'll find this slide perhaps useful to give you a little bit more practical background. The same recommendation as before, and that is, after you've done your calculations, go and check them through with your financial calculator. Again, I'd like every part of this model checked with your financial calculator so that you can be confident that you really understand the maths and be able to go into the exam confident to be able to tackle any mathematical questions that are given to you. We move now to investment strategies. I've already suggested, or rather pointed out, the difference between tax avoidance and tax minimisation. When we come to tax minimisation, we can start to consider investment strategies. How do we set up an investment strategy that makes best sense from the point of view of your taxation obligations? Here are a few general pointers. First is, generally, take your income as early as you can and pay your expenses as late as you can. If you have the opportunity to manage between taking a capital gain versus an operating income, a capital gain has the advantage rather than operating income or tax on operating income, because the capital gains tax is charged at half the rate, and also your profit, your accounting profit on that, is at the end of the project when money is worth least. Third point, aim to use interest-only loans. The advantage of an interest-only loan is that the total payment, the regular debt servicing payment, is all tax deductible because you're not paying back any principal. When you use the more common mortgage, the principal and interest mortgage, formerly known as a credit foncia loan, that part of your monthly payment which is paying back the principal is not tax deductible. It makes the modelling a bit more complicated, so we're not going to do it here, obviously, but also it makes the effective tax benefit less, and so it's an advantage not to do it. Generally, I'd recommend model everything. It's one thing to do a little bit of a ballpark estimate and so on, or maybe a guess, or adopt some strategy depending on what sort of fellow down at the bar on Friday night tells you. That might work for you, but often these things don't stand up to rigorous examination. One example, for instance, is the habit of leasing motor cars for, well, various professionals. In years gone by, leasing a motor car was a very tax-effective strategy, especially for people that were on a commission basis or in a situation where they could go into a lease for their vehicle. However, the hidden interest costs in leasing are quite substantial. In fact, they tend to trump the tax benefit. If you model your leased vehicle, you'll find that it's more expensive than if you buy it one way or another. You have the advantages of depreciation and a number of other things. But the bottom line there is model everything. It's very important to be aware of the strategy known as negative gearing or negative leveraging for property. And that's the strategy where an investor borrows so much that the interest obligation sends their operating cash flow negative year by year. The advantage of that is that in the short term you end up with a tax benefit because the property is running at a loss. It reduces the tax that you might have to pay on your day job, and so the tax man will be giving you a check every year, and that's really nice. That's balanced, at least hopefully balanced, by the capital gain that the property is going to earn at the end of the investment period. Basically, you borrow a lot of money so you can buy a property which is far more valuable than your savings would normally allow. You aim to make a loss on it because you're expecting to make a capital gain on the whole value of the thing. If you've got enough money to, say, reasonably buy a property worth, let's say, $300,000 and have it not cost you anything month by month, year by year, but the bank will lend you enough to be able to buy a $1 million property, in 10 years' time when you sell it, you get to benefit from the capital gain on the $1 million property, not the $300,000 property. And obviously, capital gain in real estate often is the lion's share of the investment income, because your capital gain is only taxed at half the rate. That's a lot more attractive than the tax that you would have been paying year by year, and also the time value of money also helps then. And so negative gearing in the past has made a lot of people a lot of money, and it's become a very popular strategy. The advantages are that it's extremely tax effective. It turns the income, if you like, from operations, which otherwise you would have been paying tax on your salary, for instance, or your normal business income, into eventually a capital gain because of the way that it works through the property. And so that definitely is an advantage. It halves your tax rate before it does anything else. It has the disadvantage, which is extremely difficult to foretell, that it turns your income into a high risk strategy. And that is because you're relying on the capital gain. Now, I think many of you, especially people living and working in regional Australia, will be familiar with the way that the capital gains on property don't always go the one way, especially if you're living in an area which is maybe affected by the mining industry, where even in the last 10 years or so we've seen mining going from an ordinary part of the Australian economy to a boom part, and property values have gone up and through the roof and so on, and then it's settled back down again and property values are looking pretty dismal. And certainly if you're living in a mining town after the mine closes down, you suddenly find yourself with a piece of real estate which is worth almost nothing. So the capital gain at the end of a property investment isn't quite as secure as it would look. Most of the stories of success relate to the capital city markets, and they tend to be working more or less one way, although even then you've got some exceptions. The bottom line there is that the negative gearing strategy, relying as it does on your capital gain, is very high risk. And it's a matter of really having a very sober look at what the risks are going to be in the markets that you're interested in into the future. And into the future means having a good clue on what's going to happen up to about 10 years into the future. One of the other aspects of the negative gearing strategy is that it tends to cause investors to be relatively indifferent to interest costs. Now, there are a lot of complex economic reasons for that, but it is quite bizarre. Normally, a property purchaser would be turned off if interest rates were going up. However, in certain parts of history, the fact that interest rates are going up has actually stimulated purchase. And the reason for that is that the negative gearing person thinks, well, that's not going to be a problem, because if the interest rates are going up, that means that the property market must be going ahead, which means I'm going to make a really good capital gain sometime in the future. And who cares the fact that I'm paying more interest now, because I'm going to get more of a tax deduction, and I don't really care. That's really bizarre psychology, if you like, but it has driven the markets at different times in living history. And so that's, I think, just one of the most bizarre areas of this. So the whole idea of being concerned about the effects of interest as a deterrent from investment tends to dissolve somewhat for the negative gearing strategy. So negative gearing strategy is quite an interesting critter. It has been very important in the past in Australia in property investment. It still is very alive in people's thinking. In many markets, it's extremely dangerous, if not absolutely devastating. In some markets, at present, it appears to be still working. And who knows, in some markets it might be a great money spinner. However, the fact that we can't be sure, and we can't be sure of the future, means it is certainly extremely high risk. And so do your modelling very carefully and very soberly if you're considering a negative gearing strategy.